Hey, what's up guys? John here. In 2008, the great financial crisis, it was the ninja loans, the no income, no documentation loans where you could essentially tell the bank what you were making, allegedly, and they would give you a home loan. Everyone was doing it. Bartenders, hairdressers, they'd have 5, 10 houses.
How many loans do you write each month?
About 60. Yeah, I was a bartender. Now I own a boat.
It was absolute mania. But now we're seeing something else in the housing market that is very interesting. It's this adjustable rate mortgage bubble that's forming. Every mortgage lender, every home buyer is told that, hey, you can refinance later. Marry the house, date the rate, refinance when rates come down, just get into the right neighborhood, forget the monthly payment. And everyone is buying properties right now based on that notion. And I saw this article today. It's like I'm seeing middle-class home buyers, middle class, buying $7,000 monthly mortgages. That is absolutely insane. $7,000 monthly mortgages thinking they can always refinance when rates come down in the future. Well, what they're not telling you and what's happening behind the scenes is what's really shocking, because banks, credit card companies, lenders, everything is changing. Credit scores are absolutely plunging and debt is at all-time highs. We're going to start to see a situation where millions of home buyers cannot refinance their properties. We're going to walk into a real problem, but a real opportunity as well for smart and savvy investors that are sitting with cash, with good credit and a game plan. I'm going to break down the facts in this video. Please hit the like button. When you hit the like button, YouTube will share this content to educate more people about what's really going on. And if you want to fix your credit, I would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. You can go there, schedule a free consultation. Take a look at this. So home sales dipped to the lowest pace since 2009 because everyone has very, very low interest rates on their properties. 2%, 3, 4, 5%. I mean, over 90% of homeowners have mortgage rates that are below 6%. So it's a very, very big number. People don't want to let go of the rate. But the reality is many people are going to be forced to. Home sales fall as would-be buyers face high rates and low supply. Look at where rates are today. If you have bad credit, say 640 to 659, 8.641%. Absolutely insane how far rates have come over 18 months. I mean, they've literally tripled. If you have the average credit score in America, which is a 698, it's 7.961%, which has fallen slightly. And if you have exceptional credit, 800 and above, it's 7%. 7%. So what does this look like? Well, if you have an 8% mortgage on a $400,000 home loan, it's about $2,935 a month. But if you are going FHA and you're taking out mortgage insurance, you're probably looking somewhere around $3,300 a month for a $400,000 loan. But in most markets, you're going to take out a $600,000 loan, a $700,000 loan, just to be able to get into the market. And so on a $700,000 loan, you're looking at over $5,000 a month. It's a pretty big number. But what's shocking here is that people are not going to be able to make these payments when they're unable to refinance. And we see inflation continue to run rampant. And we start to see banks really pull back on lending. Because in America, we rely heavily on lending for our businesses, for real estate, for investing, for everything. And if you can't get access to money, everything grinds to a halt. Well, look at what's happening right now. American credit scores that got a pandemic boost are sliding again. Bloomberg, American credit scores that got a pandemic boost are sliding again. Credit card charge-offs have risen rapidly across the industry. And I'll tell you firsthand, what we're seeing now, I own a credit repair company, what we're seeing now is we're seeing more and more and more situations of late payments, charge-offs, medical bills, bankruptcies, foreclosures. I'm seeing it on the front lines at my company. It is growing every single month. Every single month. I mean, for example, these are letters that we just received today from items that we're disputing. I mean, it's growing so fast, this credit crisis that we're in right now. I mean, folks who had paid down debt, their scores had gone up. Now they're reverting back to a more normal performance because in 2020 and 21, when all that free money, PPP loans, stimulus, unemployment benefits, all of these things came out, people are using that money in many cases to pay down existing debt. It made sense. But now that money's long gone and the debt is just stockpiling every single month. Borrowers are getting rejected for loans at the highest rate in 5 years. Banks are starting to realize that they're going to start to see more and more and more defaults. Look at this, how the banking crisis could impact borrowers. This came out 3 weeks ago. And they say here, it's going to be harder to get a loan. interest rates are going to be higher, budgets will be tighter, and that's obvious. Like, of course, we're going to start to see this when you just look at where total debt balance is compared to the great financial crisis. In 2008, $2.65 trillion non-housing debt. $2.65 trillion. Now today, it's $4.66 trillion. And if you go back to the same number, housing debt, $9.99 trillion. And here, 12, right? So 12.4 essentially. You're seeing debt skyrocket, and consumers are in big trouble. Dealers have cars and prices are stabilizing, but people can't buy a car. Here's why. Yeah, it's because loans are tightening up. Rejection rates for credit cards, auto loans, and more hit historically high levels. Now, another thing that Biden just did, and this is interesting because now they've limited credit card late fees. Now, many people might say, good, they should limit credit card late fees. But what people don't realize is that if credit card companies are suffering more losses because of more and more defaults, and they have a less of an ability to monetize a riskier borrower, they're just not going to monetize it. They're going to pull back harder on credit. And so the only people that are going to get credit card funding and credit lines extended are ones that are viewed as less risky, people with great credit, people with riskier situations and circumstances and a dicier track record according to their credit score. They're going to get really denied on funding. It's a really interesting dynamic of what's happening right now. Credit scores abruptly plunge as America stops paying down debt. Well, look at this. In the US, 45% of millennials now have more credit card debt than savings. 44% of US adults who are aged 43 to 58 have more credit card debt than savings. Overall, a record 36% of US adults have more credit card debt than savings. Here are the numbers. That came out May 8th. So you can do the math. Obviously, that number has increased over the last 2.5, 3 months. But look at this. Student loans are going to be due. They're going to be due in 73 days. 73 days. Average payment $503 a month. This is for 43.5 million Americans. We're going to see, it's so obvious. We're going to see record high defaults across the board. A lot of people are not going to pay their student loans. But with student loans, you can't file bankruptcy and easily expunge them. It's much more of a process. It's much harder. We're going to see people really pull back dramatically on spending. And we are definitely going to see a lot of losses with a lot of big banks, a lot of credit card companies, and it's going to change how they lend money. That's what's going to happen. I mean, look at what's happening right now in the credit card world that people are not talking about. When you borrow money at a lower interest rate, obviously it's much easier to pay back. But look at this. This came out from a nonprofit. It says it's going to become more important than ever to create a spending plan and create a plan of attack on how you're going to get those balances down. Right? This is a spokesperson for Money Management International. The average client for a nonprofit credit counseling agency has more than $18,000 in credit card debt. What we have determined is that over the course of this year, the 7 or so rate increases this year will mean almost $5,000 in interest over the lifetime of someone who is only making the minimum payments. So an $18,000 credit card balance, $5,000 in extra interest, not interest payments, additional interest payments because of the Fed increasing interest rates. To tackle more than the minimum, you have to create a budget, stick to it, then look for ways to cut costs. Now, I disagree with this in some capacity. If you have record high credit card debt, you should be looking at 0% APR cards. There's no risk with getting a card that has 0% compared to keeping a card that has 28%. There's no downside. There's only upside. However, you have to make sure that you are only applying for cards that you have a high likelihood of getting approved for. You don't want to get an inquiry or a ding on your credit score if you're not going to get the actual card. So make sure you're going to be able to meet the standards to get that card. That is what I would do, because making minimum payments on $18,000, you will probably end up paying $300 a month, $350 a month for 15 years. Seriously, that's how long it would probably take to pay it off, making the minimums. Don't do that. If you need to get out of credit card debt, you need to position yourself. You definitely want to focus on your credit. You want to focus on saving money. You want to focus on reducing expenses. You want to focus on getting access to cheaper money and positioning yourself while you can. Because as these banks start taking more and more losses, these 0% APR cards are going to fade away. They're going to be a thing of the past. That's something I would highly suggest doing if you have credit card debt of any size that you can't manage. You can't manage to pay off at the end of your billing cycle. You definitely want to get rid of that. And Powell is going to continue to increase interest rates, which are going to make the likelihood of more and more defaults more possible, because obviously the cost to borrow money and service debt is only going to get more expensive across credit cards, auto loans, and other bills. Home equity lines of credit, adjustable rate mortgages, all of these things are extremely risky to carry for the long term, hoping that Jerome Powell and the Fed, they do a pivot. I don't see a pivot in the short term. And looking at a mortgage right now on a 3-year ARM or a 5-year ARM, and being 6 months or a year in, and saying, you know what, they're definitely going to pivot in a year or 2 years and I'll be able to refinance then. That's based on two things. One is predicting how the world's going to turn out, and nobody can do that. Look at the last 3 years, for example. In 2019, could you have predicted 2020 and 2021 and 2022? Probably not. Nobody could have. And so to be in 2023 saying, I know how 2024 is going to turn out, or 2025, that's a very risky play, right? All we can do is look at the hard facts every single day, digest that information, and make smart, educated decisions based on what we know. That's the smart play, not taking on risky bets, hoping that everything's going to work out perfectly, because in this world nothing really ever does. But crazy situations, I think, are going to present amazing opportunities for smart and savvy entrepreneurs and investors that are aware of what's really going on. Huge opportunities coming. Please hit that like button. Add me on IG if you want to fix your credit. We'd love to help you at greatcreditfast.com. That's greatcreditfast.com. We'd love to put you in this stack here and help remove negative items on your credit report to increase your credit score, to position you for better funding, better financing, and a better future at greatcreditfast.com. I'll catch you in the next video.